Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Ryan Detrick. He's a Senior Market Strategist at LPL Financial. We're going to discuss selling in May and going away, and if this investment axiom is actually going to play out in a market flooded with monetary and fiscal stimulus. And if you're joining us on the recap, it's Cinco de Mayo this Tuesday. I don't know about you, Ryan, but it looks like stocks are not turning back here.
No, you're right, Jill. Happy Cinco de Mayo to everybody out there. But so far, stocks are pretty strong right now as we do this. But you're right, it is sell in May, go away. Historically, the worst 6 months of the year start from May, go until Halloween. Now, let's be clear. The S&P does average 1.5% over these 6 months. Not saying that's great, but that beats inflation a lot of years. But the reality of the fact is we've seen some pretty spectacular sell-offs in the summer months, August and September. And we wouldn't be shocked at all if after the 30% rally that we've seen, the record 30% rally that we've seen so far during this bounce from March 23rd, if we had some seasonal weakness, a well-deserved, 8 to 12% correction would make a lot of sense to us right here and now.
Yeah, and certainly if we take a look at this next chart here on the 6-month returns, we can see historically how that looks, but it's quite incredible, this recovery that we've had as quickly as stocks sold off. They've recovered just as quickly.
You're not kidding, Jill. I mean, it was the fastest bear market in history, fastest 30% correction. And now you look at it, we just had stocks gain over 12% in April, right? That's one of the best monthly returns ever. Now to just kind of blow up the sell and may go away, listen to this. When a month gains more than 10%, like we just did last month, 6 months later, the S&P 500 has been higher 9 out of 11 times, up over double digits on return. So there's lots of different pieces, believe me, that are out there. And you mentioned it earlier, the record monetary and fiscal policy, those aren't going anywhere. And we know those are more likely than not going to be a tailwind for stocks. But it's just, we really do feel like things are stretched. I mean, there is never, I've done this 22 years, read a lot of market history. I don't think we've ever seen a market where it's this disconnected from what's going on in the real world. See those vehicle sales numbers go down almost 50% year over year? Not a shock, okay? But what's happening in the real world and the economy is so different than the stock market. We just think maybe it's time for stocks to take a little bit of a break. And to be very clear, we've been bullish on equities here. We upped our equity allocation in late March. So we're not just, Johnny come lately, but we think this has been such a good move. It's maybe time for a little break here.
Yeah, I think you make an excellent point when you say that it really seems to be disjointed, because if you look at what's happening in stocks versus what's happening in the real economy, what's happening for real Americans, I can imagine as an analyst, as a strategy, it's got to be really challenging trying to put valuations on assets when there's over $6 trillion of stimulus in the market that wasn't there before. How do you properly value these assets?
Yeah, well, that's the big thing, right? And when you talk about valuations, you're getting into the world of PE multiples, right? That we know what the P is, that's the price. The E, I saw something that said 90% of S&P 500 companies haven't even given a forward guidance. I mean, how in the world are you supposed to have a forward guidance when companies aren't even willing to give a forward guidance? I mean, that's amazing. But what we think is happening in 12 months to 18 months from now, the reality of the fact is, fortunately, this will be over and the economy back online. We really think the stock market, it's a forward-looking mechanism. We've all heard that lingo. It's the truth. And it is saying, earnings are going to start to come back. We just cut our earnings estimates for this year in 2020. We think earnings are going to be down almost 25% this year, which is kind of right in line with what most people are thinking. But the reality of the fact is, with all of the bridge that we have with monetary fiscal policy, that's going to do all it can to help those people that are impacted. And hopefully in 12 months from now, when we're back, we can see some pretty explosive growth on the upside.
All right, Ryan, great to have you with us as always. Thanks so much for joining me on Trade Talks.
Appreciate it, Jill. Thank you.
All right, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.